What's up, guys? Welcome to another episode of Spilling the Beans. I am Tim Bratz. Today I'm sitting down with Brad St. Onge, who is one of the go-to folks over at InvestNext. InvestNext is a investment software to manage your private money investors. If you're in real estate, if you're syndicating, if you are raising money for a liquor business, like it doesn't matter whatever you're raising money for. It allows you to kind of track your investors, offer new opportunities to your investors, pay your investors, all that kind of stuff. So anyways, Brad's a member of our mastermind. We use his service whenever we're raising money and stuff. And we were chatting at the last mastermind event, and I was like, dude, we got to sit down, because his background is in raising capital. He's raised millions and millions of dollars and is seeing billions of dollars across their platform get moved around on an annual basis. So I was like, dude, we got to sit down and talk about raising cash in today's environment, in today's market. So sitting down with Brad, hopefully you get a ton of value out of it. Give me your biggest takeaway in the comment section below. And as you get value, please share this with anybody else who's looking to go out and raise capital. I think they're going to get a lot of good insight, because this dude's full of knowledge. So check it out. Welcome to Spill the Beans. Got my buddy Brad St. Onge here from InvestNext. That's one of the companies that we use, one of our vendors to manage all of our private money lenders. And these guys have been amazing to work with, and have a ton of background on raising capital and what they've seen in the marketplace with other investors raising capital. So Brad and I got connected, and we've looked at a lot of different companies, a lot of different firms to manage our investor database. And Fatty was like, we got to go with these guys. And so we've developed a great relationship. They've joined our mastermind, and I was like, dude, we got to jump on a Spill the Beans episode, talk about raising some money. So that is what we're going to be focusing on during this episode, is raising capital. Brad used to do this on his own, and then once he started working with InvestNext, he's seeing what's working, what's not working, where the capital is coming from, where it's all being deployed, and we're going to get into all that stuff right now. So, brother, great to have you here, man.
Yeah, good to be on the show. I've seen it a few times, so it's pretty exciting. Yeah, it's cool. It's cool what you're doing for the entire community, so it's great.
Yeah, I think, dude, there's just so much good knowledge out there that needs to be shared, and a lot of people keep it so close to their vest. I'm just like, dude, put it out there. I feel like you create more collaboration than competition. You know what I mean?
Absolutely. Yeah.
And so, but I appreciate you. I appreciate the relationship. You guys have been so good to work with. Everything that we've been like, hey, I wish they'd do this. And I know Fatty reaches out to you guys. You guys make the tweak, make things easier to work with. So let's dive in to, and we'll get into like what is InvestNext and all that kind of stuff, because I think what the service that you guys provide is something that's desperately needed for a lot of people who are out there raising money. They're doing it kind of on a makeshift Excel spreadsheet, trying to do things that way, but we'll dive into that a little bit later. But right now, I want to talk about let's get right into raising capital. So give me a little bit of background on how you used to raise capital, who you used to raise it for, and then how you kind of got into this space.
Yeah, so I was mortgage industry years ago, and then 2008, 2009, then I got into investments. So I had kind of like real estate knowledge, and then banking, financial investments, and then I met up with a team out of Ann Arbor and started gelling with them, and then had the opportunity to raise capital with them, which was something completely different.
Multifamily guys?
Office, literally anything. Office, industrial. It was mostly value add stuff, and then actually no multifamily at all with this one. Yeah, tons of industrial space all through Ann Arbor, the Detroit area, Southfield, all like the suburbs. So we did a townhome in just outside of Denver, Colorado. And then a couple condos in Nashville, and we started funding them together. So a lot of the stuff we did were funds. So we had 33 properties in one fund, and that was amazing. The way it was all set up, and the way we had it all done. So each property we raised capital for. You could either get in it or not get into it. You get diluted a little bit if you didn't, but you were partaking in all of them. So you can get the first deal and not the other 32, but you're part of all of them. So it just diversified your entire portfolio into one deal.
Meaning you're involved in the first deal. So how is that breaking down? Because I've always raised money on a deal by deal basis, right? 123 Main Street, we're buying. We're going to create 123 Main Street LLC, and we're going to raise money just for that project. So it's been very easy to say, hey, here's the deal, here's the returns on this deal. And every time we've tried to open a general fund and say, hey, it's like, well, what deals are you buying? Well, they're all going to fit this same sort of like return metric, but this or that, and it's harder for investors to conceptualize that. So like, dude, how do you go out and you raise money and you project returns across all these deals when you don't have the deals in the pipeline yet?
That's a good point, because it was very confusing. And
right.
when I would, so let's throw away like the big fund, because you would get 7.5% annualized, then we'd kick out extra distributions. So that was easy, and they weren't expecting a ton of money. So it was 7.5% annualized. They were fine with that.
Yeah.
But as we got more properties, if I put $100,000 in the first deal, we raised $1 million, and $100,000, and then I didn't put anything in the rest, so then we raised another $1 million. Now I'm diluted, so my percentage is down, but I'm still getting 7.5% a year. As we sell properties off, we'd maybe do a split. But
so when they get paid out, they're getting paid out. If I invested in the first deal in the fund out of 33 deals, and that deal sells, am I getting paid out at that time? Or my money stays in the fund, it's just you raised it based on that deal?
Yeah, it was inceptualized without selling ever. So it was just, you're going to get 7.5%. We're going to keep the excess. So as the whole portfolio was leveraged at about 55%. So you still had 45% equity across the board. Some were free and clear. Some had 65, 75%.
Yeah.
And then we had a bank account that had, anytime we get near 10 million, we deploy. So either deploy some capital back to the investors so they got additional funds, or a roof may have needed fixed, or a parking lot.
Yeah.
Any of that's expensive. So there's no capital calls. So you don't have to worry about capital calls.
Yeah.
They're fine, like I said, with their 7.5%.
What was the timeline that you projected on that? Like, hey, we're never selling, but
never selling. But now I've left the company, and they actually sold it all, like to big REIT companies, and it just was a killer. So it was really good for them, really good for their investments. But it was just this is lifelong passive investing where you should expect to get 7.5% a year, and they were fine with that, because like I said, the risk on that where you're leveraged almost 50%, and we had a ton of money in the bank account.
Yeah.
But the crazy thing, and like you said, it's then did a townhome one-off deal, easy to conceptualize. Then you start getting into, all right, we have two properties in Denver, 2 in Nashville we're building, and this is starting 18 to 22 months. This is probably, we're gonna build it, sell it off, and then you're going to start getting some money back. The next property got added 3 months later, next one 6 months later, 3 months, and them conceptualizing this, where at your first, everyone in it, whether you got in later or before, you're still going to earn your profit based off of when you got in. So if I got in, that's the only difference. So you could get in. I think it was left open for 2.5 years. Had 6 properties and closed it out. But the people that got in at the end, if we're already selling properties off, they're getting some more money back right away, and it was all capital, return of capital, but they weren't earning as much pref, because they're, and then once you're down to zero, all that pref got paid.
Every 6 months, the pref would drop by a half a point or something along those lines, because
it wouldn't actually. So it was all just the same pref, but I'm starting to earn it in January of 2018. You may have got in July of 2019, so you're only starting to earn your pref then, and as you go. So it was tough to conceptualize for investors, and to try to tell them over the phone. And this was, I think now, because COVID kind of helped with this, where everyone's more willing to hop on Zoom, and it would have been a lot easier to kind of show them and get them on a call, but no one ever wanted to do that. Even getting one on Zoom before a year ago, they may get on, but they're not going to even show their face or do anything, and then just try to share the screen. They're probably in a parking lot or at work on their phone anyway, if you are on Zoom. So this would have helped, but like going back to your point, I think if you don't want to get too complicated with these funds, where this was an interesting fund, and I don't see that a lot on our portal. Usually on the portal, it's a blind fund where I'm raising $25 million, and then we're deploying it into these properties, and you have to trust me as the manager that I know what I'm doing, and I'm going to put it in these properties, and that's what you're doing. So you're like, all right, here's $100,000 for this $25 million fund, and then you're buying properties, and so it's just that how's that relationship between me as the LP, you as the GP, and
So in that sense, because again, we've always raised money on a per deal basis. So we go to our investors once we contract a property, we go through the due diligence phase. Then we essentially host a webinar. We'll send out an email with the details. We'll host a webinar on it, have them come on. And then we have so many commitments that we say, hey, but you got to fund in the next 30 days essentially before closing. So it's a little bit of a tighter time frame, creates a little bit of constraint on us to get the capital raised in that amount of time. It would be a lot easier if it was like, hey, let's have a tranche of $25 million and then do a capital call every single time that you find a deal and you move forward on it. But like,
that's interesting too, because then I'm just like, and not to cut you off, but all right, do you take 10% of that? Say I'm giving you $100,000. Do you wait around and say, all right, now we know we have 30 days to get this. I'm capital calling now, and then I'm back out. Or say, oh, you know what? Something came up, and I deployed that capital. Or do you take 10% of that up front when they sign the paperwork, and then do you pay them a smaller percentage off that?
Are you paying a pref or
like
not?
2%. Usually, I'll see something like a 2% holding fee, where all right, you're giving us this, and then we'll capital call the rest. But if you walk away, you're losing that 10%, which I kind of like that versus them, all right, sign the paperwork, but now 3 months, you find a deal a month later, 2 months later, 3 months later, and then maybe I back out.
They don't have cash.
You can't really, I don't know, can you hold them in the fire? I don't think so. I'm not an attorney, but I like having them maybe have a little bit in to where you can kind of at least get something for it, So.
For us, we thought about doing that, and it's just, I think it creates like a negative sentiment right out of the gate, though. It's more of a penalty driven. If you don't bring the rest of your money, you lose 10% of your money. You know what I mean?
Yeah.
And so people are like, well, dude, F you. I'm not gonna throw my money around at this. Like, I want to invest, but I don't want all these penalties that could potentially come with it.
Yeah.
And then the other thing is, what does it look like from are you paying dividends or are you not paying dividends, right? Are you paying a return on their investment or not? And then the other thing is, when you take their money, do you start paying on it or not? Is it a lower preferred return? Do they want their money with you or sitting in their own bank account? And so like for us, we kind of, I think there's a fear of loss almost that comes in with, hey, it's first come, first serve, because I've had my back up against the wall with an investor who promised to bring money and then couldn't bring it the Friday before a Monday closing, $4 million, right? And I had to raise that money over the course of a weekend, and I was scrambling like crazy. So I never want to be in that position. So the way that we do it now is, we offer it. If we're closing 30 days from now, you wire your money today, your interest starts accruing today. At the pref that we promised you. And so that way there's a first come, first serve where people want to jump in, and they're incentivized to jump in because they start earning that pref immediately, and then it gives us the peace of mind of not having to scramble at the last minute to go and find the money, and not be worried about, but I have seen, and I've run the metrics, where if you raise the money and you're paying like a 8-10% pref on it, dude, for a few months, and that money's not deployed, dude, it can ruin the return metrics on your investments for the next 3-4 years. And so we also don't want to be in that. I think what you're talking about is a really good idea, where you bring the money in and it sits in an account, and maybe you have $10-15 million in that account. Maybe the bank gives you preferential terms on it, and you just take the 2% or 1.5% and you pass that through to the investors, and then you have the access to capital to go and deploy it when the right deal pops up.
Yeah, that's what we've seen a couple different times, and I like that, and I think
like that
that's
too.
fair, especially coming from the banking world.
But you need a track record, dude. You can't just like they want to see all the different deals that you've done in the past.
Yeah, and I don't think you're going to go from zero to fund, because I think that'd be crazy. But I like the one-off projects. Simpler. It's easier to talk to the investor about. They're not confused. And I mean, that's the last thing you want to do, because I see a lot that'll start and they try to get really complicated with stair-step different classes. So let's say you give me, you don't want any sort of the upside, so you're not doing any split, but we're going to give you 10%. So your class A is now 10%, but no upside. And then you've got,
with no equity in perpetuity, you're saying.
Yeah,
right.
And then class A1 or class B is 9%, but you're getting a split, but your pref is 9%, and then but you're giving a little more money, and then there's an 8%. And I see people get really fancy with it, and then after the first one, like, this is crazy. I'm just going to do pref and then split and then go on from there. So I think that's one of the, it's like, stop complicating it, and don't do today. Like, go where you want to eventually be. And a lot of people will sacrifice their split to where they're like, hey, maybe we do an 80-20 split, where they actually want to do 70-30 or 60-40 because they're doing all the work. And that's when they eventually see it. But don't start raising capital where you are today. Raise where you want to be, because then now you've got these investors at an 80-20, and if you're like, hey, I did a lot of work on that property, we didn't make that much off that 20% when you actually sell it, and then let's try to do 30%. But all these people that got in this first year, like, I don't really want to. Why are we losing our 10% on this? So it's that's kind of something I see.
We've always tried to, and I agree with that 100%, man, because it's, especially right now, there's a lot more money out there than there are deals, and the deals that you have to get into in order to make the returns and hit those targets that you want for your investors are harder to find. You're spending a lot more money. You're contracting more properties, losing potentially money on due diligence and inspections that on properties that you could probably walk away from. Who eats that? It's the operator that eats all those things. And then the deals that you do find that seem like good opportunities are typically, they got some hair on them, dude. They're pretty heavy lifts. There's a lot of work that goes into them. They're either new construction or they're just heavy value add type projects where you're really forcing appreciation. Yeah. But dude, that takes a lot of work and many, many months, even years of effort in order to stabilize those deals.
And a lot of no's on your part, which they should be paying for. Like the investor isn't just investing in this deal, they're investing in you for turning down those 9 deals that you visited for. So like, who's paying for that? You've got to start putting that back in, and that's where some people are against fees when they first start. Like, charge your fees.
We didn't, dude,
and
we had some skinny days because of that, right? Like, you got to charge some fees.
Then to start, because you don't want to be in. The investor shouldn't want you to be living on your parents' couch to try to get through this. They should be like, all right, they're comfortable with this, which is good, because they're not now reaching out to try to grab other deals just to kind of make up for the fact that they're not getting fees. So I would charge fees for sure. Like I said, you don't raise capital for today. If you're starting, raise capital where you want to be, and then just stick to your guns. So
I think we've always tried to focus on what are the targeted IRRs, right? Like, what's the internal rate of return annualized between the pref and the equity and the cash flows that come from it and everything else that comes from it. And refi proceeds, a little bit less of that now than a few years ago before COVID.
Yeah.
But what is the equity value once they've gotten all their money back and all those things? And so we've always focused on that, but it is very surface level. People are like, well, how come you're keeping majority of the equity when I can go and get the majority of the equity over here in this other deal? Well, the reality is, dude, that person is buying a $10 million deal for $10 million, and you might have 70% of the ownership in it. But what is 70% of no equity? It's worth nothing, right?
Right.
Versus one of my deals, you might own 25 or 30% of the equity, and as the LP, as the limited partner.
Yeah.
But I'm all into my deal for $7 million, and it's worth $10 million. So there's $3 million of equity, and you got 25% of it. That's worth $750,000, right? So it's like, what's the deal, and making sure that you educate your investors, because very surface level, they're going to look at how much equity they get in the deal, as opposed to like, what is the actual return metrics in that?
Right. Yeah. That's an interesting point, and a valid point to really hammer home when you're talking to them.
Yeah, man. So like, we typically do. I mean, I don't know if you've seen Grant Cardone's stuff. He doesn't even pay a pref anymore. He got rid of all pref payments when COVID hit. So he does not pay a pref. You come into his deal, and I think most of his are like a 50-50 split. I'm not totally sure on that, but I think it's around that. But essentially, investors get 50% of the cash flows. And if there's no cash flows, they get nothing. And it doesn't accrue. There's no like payday in the future. It's like they get 50% of depreciation, appreciation, cash flows, and that's it, right?
That's interesting.
It's fascinating, right? Yeah. But when you have access to that much money, you can kind of steer the ship, right? And I think he raised $600, $800 million or something this year or last year for different deals. And he was able to just get rid of the pref. Yeah. Like there's no fixed return or predictable return that the investors get, and they're okay with it, And I think if you're in that position, you have access to that much money. Yeah, dude, the preferred return actually creates a lot more liability on the operating partner than anything else. So
yours is, I mean, you've got the split after. You've got like the perpetuity model though. You keep this for a long time. Which is another benefit, because you could be 70-30 or 60-40, whatever it is. But then you're selling the thing, and then you're taking 10% of that equity you have, because you're paying off fees and you're paying the brokers all their money. But I like, if I could give you $100,000, 2 years later, 3 years later, you refi back in when you could refi, and I get all my money back, I don't care if I'm getting
Everything's
2 to
icing on the
5%,
cake, right?
that's free money, because then I'm deploying that 100 grand back in. I'm getting a pref with that 100 grand.
Yep.
And that's the same 100 grand. I have X amount of equity, so when you sell that property, I still have an equity position in that original property, and then I'm getting 2 to 5% maybe on my original cash that I'm getting a year that you're splitting, and then you do that 10 times. It's the same 100 grand over and over and over. Then you have equity in each one of those deals, and then you're getting this 2 to 5%, 2 to 5%, 2 to 5. Now you're getting 10 to 25%
on money that's not deployed any longer.
On that same 100 grand or whatever it is, and it's a beautiful thing that I think some people are a little short-sighted and maybe they're trying to grow their wealth, but they don't understand that that equity too. You've got that equity that's now part of your net worth. That if you actually do sell it off, who knows what that's going to be down the road.
And dude, you got principal pay down on it. That's increasing the value of that equity. You got property appreciation. That's increasing the value of that equity. You're getting all the depreciation from it too. That offsets a lot of the cash flows that's kicking off.
Yeah.
But yeah, man, it's once we sit down with our investors and we're like, listen, you can get into one deal over here, and on paper it looks good or whatever, but when you look at what the actual returns are, because your money's deployed for 5 to 10 years versus one of our deals, and it's deployed for 36 months, and we refinance you back out, get your cash back, and then we can cycle you into 3 or 4 deals in the same amount of time, and you start seeing the velocity on the capital and what that does for a return metric, dude, toe to toe, man, it smokes everything else that's out there.
It's so powerful.
If you could just turn your money into 2 deals versus 1 deal, right, in the same time, it smokes the returns. And then when you start looking at 3 turns or maybe 4 different deals that you can get into, dude, it is those are hard deals to find, first of all, and if you do find them, it's a lot of work that goes into them. So you got to pay attention. We don't like to nickel and dime on fees, but we now we take an acquisition fee, a nominal one, usually a couple of points, but we usually don't take an asset management fee or a dispo fee or a sponsorship fee or a fundraising fee or anything like that. We take an acquisition fee, and then we want to be in the same boat, rowing in the same direction with our investors, so that way we're incentivized. We get paid more when they get their money back, right? That's when really the cash flows start getting distributed to us as well.
And that acquisition fee isn't, that's putting the lights on them, but it's paying back for you visiting your property in Indiana, like flying out there, the team to fly out there, all the marketing stuff you do, everything goes into it. It's not like you just have that cash and now you're just ready to party and get on with it. It's essentially paying back stuff majority have done, and maybe put a little money in your pocket.
Goes in the operating account, and then we're searching for other deals, and trying to source new opportunities. So, give me your feedback on this. What are you seeing from a return perspective, or any changes that people are doing just because the market got so tight with deals? There's a lot of money out there, right? Where are people finding the deals, and what kinds of deals are you seeing capital deployed into right now?
I see, location, I see Texas a ton, I see Florida a ton, the Carolinas, both south and north. And then you've got this Midwest little run where it's Lexington, Kentucky, some in Tennessee, Indianapolis seems to be pretty hot. So I see a lot of that area. We used to see Huntsville, Alabama, that seems to have dried up, but Huntsville was crazy for a while, where I don't think anyone could find anything because everyone was trying to get it.
What was that? Probably 3-4 years ago, man. It was going bonkers.
Yeah, it was crazy.
Yeah.
And that's all a majority multifamily. So then we're starting to see a lot more storage and mobile home parks kind of get on there. I think industrial, I keep reading about industrial is going to be pretty hot this year, but
What storage facilities?
I don't know. What's that?
Storage?
Yeah, storage. Storage is interesting too. Those seem to return pretty well on the portals.
I mean, the beauty of storage is if you do a cost egg on those, man, you can get about 40 or 50% of depreciation in all year one.
Oh, really?
Yeah. Whereas multifamily is probably 25 to 30%, and then really retail and office is somewhere that 15 to 20% typically for the accelerated depreciation stuff. So that really is advantageous for investors.
And you don't have to wait 9 months to kick a tenant out, and the turnover, literally, if no one's paying you, you're like, all right, see you later, we're throwing on storage wars, we're gonna cut your locker and sell this thing, and then
exactly.
Then you get going, so it's pretty it's pretty nice in that. And essentially you buy these mom and pop storage facilities that you want someone who hasn't done anything in 30 years. You know, they have no internet presence. They have no software, any sort of thing integrated in there. So people are still paying checks. And you come in, you change that whole model up. You know, people can now pay online. You've got a presence in the area online now. They can find everything and then actually sign up online, so you can eliminate some of the management. Those are pretty easy, or not easy, but pretty quick things to turn around, and then you're, you know, as opposed to, you know, turn any unit where someone may blow the unit up or anything. So, so that's kind of interesting that we've been seeing there. So.
What about supply of those though? Right. I think
so many people are doing.
Dude, there's so many people doing it, and the more, I mean, I've done 3 storage facilities. All have had great returns and done well. I also bought them before it got so hot, right? So there was a little bit of the market coming into play. So you gotta pay attention to that.
It's tough.
But dude, like there's statistics that, let's say, I think it's, I don't know, let's call it 8% of the population uses storage units, right? And as soon as more units than 8% of the population are created in any certain market, it starts cannibalizing itself. And all of a sudden, all occupancies drop across the entire market because there's too much supply. And you just, I mean, you know, in some of the growth markets, in the Texas and the Florida and some of these, you know, as long as population continues to grow, you're good. But, dude, they're getting built like crazy.
They are.
It's quick to throw them up. You know, they're fairly inexpensive to build, and you start looking at it that way, man. You're like, that's an industry that can really create a bubble or an asset class that can create a bubble pretty quickly, I feel like.
It's crazy. I started noticing it a lot more too, because I used to notice multifamily homes, just driving around seeing them, and now I notice storage a ton too, because I'll look and be like, oh, that looks like a gold mine right there, that one. And then on the drive here from Myrtle, I was driving, I saw a little looks like a mom and pop, and I was thinking exactly that. And then literally an eighth of a mile,
brand new.
Yeah, the monster, brand new, all indoor AC stuff. It was like, wow. And it's, you know, that drive, I don't know how much traffic is along, or how much the population along the way. I don't think it's that great. So I'm sure that one's just cannibalizing the other one. But you start kind of noticing. And I've noticed storage a lot more, because it's usually right off wherever I'm driving around the country, and it's like, wow, storage.
And I think, I think in the storage side of things too, you're not living there, right? So it's a little bit less dependent on location, and it's less dependent on how nice it is, you know? Although the one's nicer, it's probably a shitload more expensive. Is it worth that much more than the mom and pop one that's $100 a month for this unit? You know, especially down south, the air conditioning thing's a big deal, because otherwise it get all moldy and mildewy and gross and stuff.
And
but
I think maybe heated up I don't know if heated up in the north's a big deal. I don't know.
Yeah, I mean, I don't think.
I guess your crap can.
I don't know.
Freeze.
Yeah, whatever. But it's like, I don't know. Are people going to pay a premium in order to have a little bit nicer of a unit? And is it going to be that much more of a premium? I don't know. So the way that construction costs are increasing, and can you really compete with, you know, $3,000 per storage unit over here when it's costing you $30,000 to build per storage unit over here? You know, so it's. I don't know, man. I think it's going to be. I think it's fascinating. I just like apartments, man. Because I know if I have the nicest apartment in the area, I will attract the best tenants,
right?
You know, and the most qualified tenants. They're going to move into mine. And even if the supply goes up, I'm going to have the nicest units at the same market rate rent as everybody else, and I'm going to attract the best tenants. And somebody else's occupancy might go down, but mine won't.
Right.
You know.
Yeah. Yeah, I like it all, and I'm not an expert at any of it. Finding the deals, and that was never anything I did.
Yeah.
But it's always cool to see the different stuff on the portal, though. But I haven't seen. It does seem like locations for storage are Midwest too, or like rural, you know, like the tertiary markets.
Very much so. Cheap land, you know.
Yeah, no one's buying in like downtown. Well, I'm sure people are. But,
I mean, there's a little bit downtown, but it's hard to find, man.
Yeah.
Hey, what's up, guys? Hey, do me a quick favor. Give me your best takeaway so far from this episode of Spill the Beans in the comments below. Smash the like button. Show me some love, please. And also, share this. Subscribe to the channel so that way you get all the new episodes of Spill the Beans. Appreciate you. No, that's good. So tell me about where's the money coming from, right? It's being deployed in the Carolinas and Texas, and we were talking a little bit offline. South Dakota is like a big one, right? There's a bunch of money getting deployed there too.
Yeah, we have a couple, and blows my mind. So we have a couple really good clients that are in South Dakota, and it's you just see thousands of investors they have. It's crazy, and they're just deploying tons of cash. So people in South Dakota they're hoarding all the cash. I think.
Really?
Yeah, it's crazy the amount of money. But it's interesting because being from Michigan, there's the Lower Peninsula, Upper Peninsula. You probably know that. So, but UP, a lot of people from the UP actually go to like North Dakota, South Dakota, and they work because there's the pipeline, and so they go out there. But just apparently a ton of money in that because I see a lot of people investing from that. But you'll still see a lot of Texas, a lot of California money coming from Texas.
California going into Texas.
Yeah, a lot of even though they're exiting and probably traveling to Texas, they're sending their money that way too.
So pretty much like what we'd expect. You're seeing the expensive West Coast, the expensive Northeast, that money getting recirculated and deployed into really the Sun Belt, right?
Yeah, the Southeast is huge. We see that a decent amount in obviously Houston. Houston's big, the kind of triangular Houston. Yeah. Houston, Dallas mostly, and a little bit in Austin, but not too much. But I think a lot of it is still. There's a lot of syndicators or people trying to quit their job to syndicate. So I mean, you could be in Cincinnati, and a lot of their investors are going to be Cincinnati because it's going to be people they know. So it's interesting, and it's kind of tough to see where they're all coming from versus where our clients based out of, but it's usually still in those kind of areas. Because we'd have to go dive through the numbers of like, where are all these investors? Some are all over the board, but usually see New York, Chicago. Where
are you seeing operators and capital raisers mess up, right? Like, where are they being a little bit too loosey-goosey or getting in trouble? Like what type of hurdles do you see people facing where they try to, I don't know. Well, what are the hurdles, one? And then two, where do you see them like messing up in that space?
One thing you talked about earlier was, all right, I only have 30 days to do this, raise capital, and you're kind of like worried about it. We'll see people, it seems like, wait forever to start getting soft commitments. And that's when we'll be like, hey, could someone help me build out this deal room and try to create all this stuff? And like, all right, when are you raising capital? And they'll, today. And you're like, you didn't just buy, you didn't LOI this today. Yeah. It had to be 6 weeks or plus ago. When you know you're good to go, that's when you should start, build out your pitch deck and then start getting soft commitments. We see people wait a long time, and they've got to be nervous as hell because, like, you're nervous still for 30 days.
But I've had the pipeline built out, right? Yeah. To your point, I'm not waiting until I even get a deal. I'm having a conversation with people saying, hey, I buy apartment buildings. Do you ever look to deploy? Like, I'm talking to people today about deals that don't even exist yet, of just conceptually, here's how I buy. I'm on this podcast, right? Like and I'm talking, hey, I buy apartment buildings that are value add. I go in, fix them all up, put good tenants in place, put good management in place, turn around and refinance them in 36 months. I bring on investors for the down payment capital and operating capital. I pay a fixed return. And then when you get your money back in 36 months or so, you keep a piece of the equity forever, right? And you can build long-term wealth. Dude, you talk conceptually about what that looks like, and people are like, I'm interested. Put me on your list. Brad, I'm in for the next one, And so then you put them on your database, you shoot them a message when the deal does come up, and they've already been kind of warmed up, When you have a deal and you just take it to somebody, they're not warmed up. They didn't even know that you raised money. Yeah. And that you raised money this way and that you did this. And so it's harder for them to make a commitment when they're still trying to just absorb a lot of that stuff. Yeah. If they already know that you're buying apartment buildings and you raise money and you pay your investors this way, now it's like, okay, I feel comfortable with Brad. Let me just look at the return metrics here and the deal. Does it make sense? Then I can easily make a commitment to you, Yeah. And I think people they're waiting until they contract the deal, and I think you need to be sourcing deals and raising money at all times.
Yeah, raise money immediately, especially on the deal, and that's fine. Some will maybe have a spreadsheet where they have everything out, but then that's cool. That's but start when that's when you should start trying to raise capital, not wait. It seems like it's a lot of newcomers. It's near the end, and they're like, all right, we got to start raising. Like, you should have this bad boy fully reserved and ready to rock.
It's not as easy as people think it is. Yeah. We talk, hey, there's a lot of money out there and this and that. Yes, there is for people who have done deals and know what they're doing and have built up their list and have planted a lot of seeds for many, many years. It's easy for me to then shoot a message out. I was on call last night, 10-minute call, raised $500,000 from an investor. But he's been investing with me for a long time, right?
Yeah.
And so he just wanted to hop on a quick call. What's the deal? You know I'm in. Filled out the paperwork at 9 o'clock this morning, and then he's like, I got funds ready to go. You know, so it's many years of cultivating those relationships, though. If you haven't done that, dude, you got to start cultivating those relationships right away.
And I think that's maybe a hidden art. So it's not, or there's kind of two things I think of here. So when we used to have a property, and most, if you're local, so if all your investors are kind of, or if there's some in an area, so if you have a ton in Charleston and you just bought a property in Charleston, throw a party at that property. And,
I love it.
And so we used to do this, and we'd have an industrial building that was just all cement, and we'd throw a party, we'd have a party, invite every investor, invite friends. That's low-hanging fruit to hopefully get them to invest. They come, so you have them like, hey, we're having booze, we're having food, we're having a band, come here, you can destroy it. It's because you're going to destroy it anyway. If it's a multifamily property, we used to have, I worked for another company, we used to have multifamily, and before we tore the whole thing up, we'd have a party. And then when we fixed it all up, because we got the whole thing, we'd have another party. And you'd see the beginning, and you could tear it up, party, it doesn't matter, because you're messing up this thing you're gonna mess up anyway. And then once it's done, you see the product, and then always invite them to bring more people, because that's like low-hanging fruit. And then if they see this, like, wow, this is crazy. And then another one that I see a lot of people miss out on is the referral. And it's easy as asking for a referral, and the easiest time to ask for a referral is now you've done a refi, I'm giving you all of your money back, I'm sending it to you, that's fine, but you're getting a call from me. And if you have a big, like a disposition, if you actually sell a property off, or if you're not, don't call them every dividend you're sending out, but if I'm giving you your money back, you've invested 18 months, and I'm pretty stoked about this deal that I just did, I'm calling you and I'm saying, hey, the money's coming, or the money should have hit, or at least letting you know, and then having a quick conversation. Like, who do you know that's interested in this? But at least if you're calling and then you're asking the question, the least they can say is, I don't know, or just don't say, do you know anyone else? And then have them say yes, but just like, who do you know that's interested in real estate transactions like this? You know, after you've just like hopefully blown their mind with the deal, even if
I think even dividends, even dividend payment. Like, I mean, we don't make dividend payments on a monthly basis, because I think that could, and you're asking for money every month, that could be a little bit overwhelming. But on a quarterly basis, we give our quarterly distributions, quarterly updates, so they hear from us. They're happy, they're more confident in the project and more confident in us, and we just let them know, hey, we got some other stuff that's in the pipeline, keep an eye out in the portal, because we're uploading new deals all the time, and then it's just, we're touching them, right? We're touching them. Because I found that investors and them investing in your projects, once you build the rapport, it's all about timing, right? Do they have access to the capital at that time?
Right.
Did they just get paid out from another deal? Did they just sell a building? Did they just sell their business? Did they launch a product? Did they just reinvest into their primary business? They don't have as much capital. It's all about timing. So the more you can stay in front of them, and I think on at least a quarterly basis, just touching your investors, letting them know that you got some deals in the pipeline, and just taking their temperature of, hey, how much you looking to deploy and what kind of time frame, and that way you can kind of, ballpark how much money you'll have for these different deals that are coming up. To know all that stuff, did they sell a property? You're not going to get that by just emailing them an update, because you're not getting any response. So even if you try to get some, a quarterly touch to where you're talking, where I don't see a lot of people doing that. It's just, here's our update, here's our update, here's our update. We sold the property, and then another deal comes in, here's the deal. And it's like zero from them, because you're not really giving them a reason to talk to you at all. So I think that's a huge point there that's kind of missed across the board. All right, so we talked a little bit about the newbies. Where are they messing up, right? The people who are raising boatloads of capital, what are they doing right? What are they just like hitting on, and they're just in the rhythm? How is it so easy for them? What are the things that they're doing on a daily, weekly, monthly basis in order to just like raise boatloads of cash all the time?
I think it starts from the brand, so it's like top of the funnel, kind of like you do. So you're the brand, so you're the top of the funnel. You're doing all of this stuff here that you don't have to do, but this is driving driving a ton of business. And then you set up, you've now set up the funnel in different stages of the funnel. So you've got someone who's then going to capture that. So the IR department's going to come in. Yep. I'm sure you've got some sort of marketing active campaign or HubSpot that you guys use that's catching all that stuff. So you got some drip campaign that's kind of catching it. And then you've got all these things in pieces, and then you can, I don't know if you guys put a scoring system with so I'm sure you got your marketing thing down. So you know everyone from all of this information that you're kicking out, that everyone that's driven there, then starting to go down the funnel. And then once it's time to actually like get a deal, you know those people that are, well, you can send it out to everyone, but then you'll know everyone that's actually interested, maybe like potential investors. So on our portal, you can build out like a deal room, and you can send that link to them, and they can actually sign up. So you don't have, I never have potential investors sign up before, because you just throw 10,000 people in there, and then you don't know who's really active, because it's, I mean, Active Campaign will monitor a lot more stuff than our portal will, because they're really good with marketing, they're good with analytics, they're good with, hey, did this person click on this, how long were they there? And then if you send the deal room out and they actually sign up to the portal that never were, then you know that's a hot lead, that person's there. So there's like different aspects where I think there's a ton of things that need to happen before it comes to us, and then once it's at us, then you know, like, all right, you know, Brad signed in, he's never been in here before, he put that he's interested for $100,000, like we should reach out to this person ASAP and make sure he knows everything about it. I think the better ones will reach out and have a conversation too, so they know what the deal is, even though they've probably read it, but I think if you answer questions up front, you'll get less questions down the road. So even if you call and if they don't want to call, that's cool. If they signed up and you're cool with them just signing up and sending your money, that's fine as well. But they may have questions down the road about stuff like, what's the split here on this? And it's like, well, you didn't know that originally. And then, so I think if you can be proactive on those people too. But granted, we have some big clients that have, I mean, you're raising $24 million over a weekend. You don't have time to do that. And that's not the issue you have, but because you're probably going to be able to raise another $24 million after, $24 million after. But I think putting the processes in place.
How are they raising $24 million? How much exposure? Like, I love what you said about, in a roundabout way, you said they're not, secret agents, right? They're telling people, and they're letting people know that they bring on investors. It's not like it's a secret or anything. Like, people know that they bring on investors for their different projects, and that's that top of the funnel that you kind of mentioned.
I think it's mastermind. How are there masterminds?
Yeah, dude, the masterminds are awesome. Like, and that's
teaching programs.
I don't get paid to do this social media stuff or YouTube videos and all this, but we're expending a lot of money, right? We have cameras, we have staff, we have all these different expenses that come with creating this. And the idea is, educate people, and maybe they want to partner up with us in one way or another, right? And so we understand the long-term mindset of making an investment, educating people, developing the relationship, developing the trust, developing the confidence with our investors and with our database of investors, and then just anybody who's watching us as well. There's a lot of relationship and rapport building by doing this. Not everybody does that, though. Not everybody's out there putting out a ton of social media content. How are some of these groups raising $20 million in a week? And where's that money coming from? We have a couple who I've never even heard of until we got it. Like, they reached out for a demo and we had them, and I'm like, I have no idea the answer to that, because a lot of the ones that I know of are like like the Brandon Turners and you and the AJ Osbornes, who are out there pumping. It is good, dude.
Pumping a lot of stuff out, and then so you see that, and then some of these other ones are like, how are these guys? How did they raise? And I don't know if they've been doing it for
family
so
money.
long.
Do you think it's like they go to a couple of family? I mean, they're raising from individuals, though.
Yeah.
Right? Like, what's the average on somebody who's doing deals that size? What's the minimum check size typically?
$100,000 on that.
Really?
Yeah.
It's just they have a network of people.
Yeah. There's a couple, and I don't want to say the name, but it's just like I'd seen like. That's insane. And,
really?
And they'll like, hey, we did a webinar, we need help getting this up and running, and then you get it up and running, and then literally like 48 hours later, it's insane. And I'm like, this is crazy.
And they don't have a big social media presence or anything along those lines?
Yes, some of them don't. Yeah, it's crazy.
Wild. Like,
some of the ones that do, you know where that comes from.
Yeah.
Otherwise, I'm like, I don't know, maybe they've we have some quiet ones. We're a little bit on social media that have been wealth advisors for so long, and they have access to a ton of capital, and then they start doing this because like, hey, I don't want to work for JP Morgan, or I don't want to work for Morgan Stanley, and they're making more money, and it's they're actually putting them in stuff that isn't a fund or or a mutual fund or index funds.
Yeah, I can see that.
But I think see a couple of that are. So it's interesting, and I don't know 100% the answer to that, and I'm sure they've done stuff along the way, or so it seems like some former tech or IT individuals have quit, and now they've got that network of all their engineers they used to work with that have access to capital, and they've been doing it for 8 years, and it's just kind of like returned pretty good.
And everybody's making money. They just sold off a portion of the company, and everybody had like a little bit of stock options. Now they all have cash. How much is coming in from like 401ks and that kind of stuff? Like self-directed IRAs, 401ks.
Yeah, a lot more, and that's a tough animal when you have a software program and you're trying to have the legal name in there. So we've done a couple different things, which I think we've got it as good as it could possibly get. But when you're, and this is like probably a different. I don't want to go down the rabbit hole, but a lot of custodians, and there's a couple. It's great, but this is probably a good question though. So if I was raising capital, used to, I had one custodian that I'd use. One custodian we
move everybody over to that one.
We would move everyone to that one because
That's a great point. Creates a lot of efficiencies and batching.
Even if you have two, that's fine or whatever. But we had one that. If you were doing an IRA, I don't want to talk about the tax implications. I don't want to move it. I can't move it all. I refer you to our IRA person, you two and the IRA person talk. When I get our legal documents, I'd send them to the IRA company. The IRA company does all of them. So, because what'll happen,
like the valuations, the annual valuations on this stuff.
Oh, they'll do that stuff. Yeah, it was just crazy.
Such a headache.
And to have it go to one person, fantastic. But the legal documents and having the investor fill it out is a nightmare because if I'm an investor and I'm a doctor and I've got this IRA, I don't know what my IRA is titled. I don't know that it's Equity Trust Company, FBO, Brad St. Onge, IRA number 157. I don't know the address to the IRA company. When I'm filling out the paperwork, I don't really care. I just want to get the paperwork done so I can give you a check and get it done. So they're just throwing data in there that then you need to print it out, send it to the IRA company. The IRA company is like, you messed this up, you need to do this. So it's like if you get an IRA company that you trust, a custodian, anyone that has an IRA, say you're not filling it out in the portal. Like we still have it to where you can go through and fill it if if you pay attention. Send it to them, have them fill out the paperwork, send it back to you. You can just upload it in the system. It's right. The investors have to try to fill it out 3 times. The IRA company's actually filling it out. The paperwork's done, and then they cut you a check. The check comes a couple days, or ACH or wire, whatever they do. That's probably the best way to do it. Yeah, but because we see so many investors that are trying to, and we've, like I said, we've got it to where I think it's as helpful as possible, but if I'm putting in junk data just to get through the system, then the paperwork's going to be incorrect. And I would do the same thing. I get on stuff, and I'm like, I don't know what this is, and throw it in, and I'm like, what did I don't know what I messed up, but it's going to come back, and the IRA company's going to be like, no. So I think if your custodian's a true custodian, they'll be like, hey, let me run this. They can go over tax implications and all that stuff, and so that's what we used to do, and that helped out tremendously. So any more than IRA, we'd give them 2, but we'd be like, this is the one we kind of like, And I think that's helpful.
I mean, it's a lot of work and a lot of hoops to jump through when utilizing IRA money, man. And then they almost passed the tax bill. Biden's bill or the House bill or whatever almost like didn't allow IRAs and 401ks that are self-directed to invest into accredited investor investments. But that all got scooped out and removed over the course of the back and forth, whatever in the House. But
I think that's
that could have gotten hairy, man. Everybody would have had to repay their investments and all sorts of stuff. It would have been tricky for a lot of people who invested in.
Yeah. Another thing is too, if you have a good custodian, you know that when you're actually sending distributions as opposed to the individual filling everything out, I mean, they may put their own bank account in the system, and then you're sending checks to them, and it shouldn't be sent to them. So I think whenever you can get the custodian involved in that, it saves on a lot of errors that you're probably going to have down the road. there's different naming conventions for each one of them. So it's like I said, it's kind of getting into the weeds here a little bit, but I think ultimately the whole gist behind is that get 1 or 2 custodians that you're comfortable with and just route everyone.
Yeah. Yeah.
That's probably the easiest way.
No, I love it, man. As we kind of wind down here, dude, I again have looked at a lot of different softwares. I know you're not here to kind of like plug InvestNext or anything, but I want to make sure that people realize that they don't have to manage all their contacts and all their investors and stuff on like an Excel spreadsheet. You can do it in a more professional way. So give me high level, or let's give everybody a high level on like what does InvestNext do? What are some of the benefits and the pieces and parts of it and things that it can do for you in order to just kind of simplify your life?
Yeah, I think at the end of the day, like saving time is the overarching goal that we have. Like, democratizing real estate, which a lot of people are trying to do, and that's what we're trying to do. But saving you time, and what I mean by that is, all right. So when you are now going to get soft commitments, you build out a deal room from your pitch deck or sales deck, whatever you have. Now you've got this deal room sent out, so you can then send it out. Everyone, the investor can run it from that point until they send you money. Where it used to be, I'd have an email, I'd send you all the documents in an email, you would mail it back to me, or you'd fill it out and email it back to me. It's probably going to be incorrect. So you can set up the templates to force like individuals to fill it out correctly, LLCs to fill it out correctly, because you can force them to fill out the fields. So you're getting, the document is going to be more correct. They can actually fund through the portal now, so they can send their ACH to the portal. You don't have to go to the bank and reconcile $2 million and say like, all right, I don't know who this LLC is because I may have invested as an individual and sent you some random LLC you've never heard of, and then you're trying to reconcile that. So it'll reconcile that, so you have to go through that, which saves you time. When it comes to actually paying your distributions to your investors, you can pay that through the portal. So if they've sent you funds, their bank account's already linked in the portal, you can just send funds back to them. Tracks on their end too, which hopefully eliminates questions from them, so they can log in, they can see all their documents, they can see all their investments, all their dividends, all their pref, all their return of capital. They can visually see all that.
Their K1, literally everything is in there. It makes it so much easier.
K1 right around the corner, which is going to be a nightmare. It's always a nightmare. March 15th. It's never done by March 15th, and every one of your investors is going to be like waiting to do their taxes.
Everybody.
They're not going to get them until April.
Dude, there's almost no real estate investor who's operating at a high level has all their tax returns done by March 15th.
No.
Dude, we still get like 1099s and all the sorts of different bills from different organizations and subsidies and utility companies and all that kind of stuff. Dude, coming in after, it's not, we're supposed to have it by January 31st. There's no fucking way. It just never happens. We never get it. It's into March and April that we get these documents, even though, and then we have to amend it, right? So now we're just like, we just tell our investors, plan on extending your tax return. And we'll get it done, early summer kind of a time frame, just because that's a realistic time frame.
Yeah, March 15th has never hit ever.
Dude, never. I don't know anybody who does.
And at least making them aware. So at least it helps with that, because you can mass upload those once you actually get them. So if you've got 100 investors in a deal, and then at least it saves you a little time. Where we used to, when we were raising capital, we used to have to mail all those out. And not only are they pissed that it's probably May, and now you're like, hey, these are coming.
Snail mail.
Yeah, you'll get them. Hopefully they show up.
USPS loses it. I didn't get it. It's really simplified things for us. Everything's in one place. A couple emails this week, right? Hey, I didn't see this, or did I finish that document? Have you logged into the portal, right? Just go into the portal, you'll see, and blah, 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 everything's good to go. So it's made it so simple for us to continue to manage. We have, 400 different investors, you know what I mean? And so to be able to manage all that, and then every time you upload a deal, everybody's notified that there's a new deal in the portal, and they can come in and check it out, and even if they didn't get your email that you sent out because it went to spam or something, or their assistant deleted it or whatever, it makes sure that they get notified of all those new projects. So dude, I can't tell you how happy we've been with InvestNext. So you guys have been doing an awesome job, and every time that we reach out to you and say, hey, what about offering this or tweaking that? You guys have been so receptive on it and been like, all right, hey, let's see if we can make that happen the next 90 days for you, and you guys always have. So it's been awesome. It's
been good to get the feedback too, because that drives it forward, because we have being that I used to raise capital, it's tunnel vision of, all right, this is how I think you raise capital, but then now that I've been in here, we have tons of different clients. It's
Yeah,
like,
yeah.
all right, no, there's
All
a ton of
different ways.
different ways to raise capital. It's crazy, but so
Yeah.
it's been good, yeah.
No, man, it's fascinating. If you know how to raise capital, dude, it doesn't matter what business, what industry you're in, you can move the needle forward and make a lot of money. I think, capital and money is the resource that drives all industries, So if you can control that, finance, if you can do really, really well in whatever you're doing, you know, because you can go flip businesses, you can go flip real estate, you can go and start new operations, you can roll up companies, you can do like literally anything if you understand how to raise capital. So, all right, man. Well, dude, I appreciate you being here.
Yeah, thanks for having me.
Always fun.
Yeah.
And I know you can't make the Vegas summit, but we'll see you at the next one. We're not going to release it yet. Not going to tell you guys where the next Legacy Family Summit is going to be, but pay attention. We'll probably notify everybody and release it late February. So
Perfect.
Pumped to have you there, man.
Yeah, thanks for having me on.
Really good stuff. A lot of great takeaways. Would love to hear your best takeaway in the comment section below. Do me a favor. We create this content to try to give as much value as we possibly can. All I ask is that you like it, give me a comment, maybe share this with a friend who also does some capital raising for their business, so that way they can get the same insights and same value that you got out of it. So until next time, I'll see you guys on Spilling the Beans.